Hey traders, this is Ron Haight. Happy Tuesday. Hope you guys are having a great day. As always, everything in this presentation is for educational purposes only. Daily chart of the S&P 500 is on your screen using Thinkorswim. Another day, the market just keeps on moving higher. It's like a broken record. Target right now remains the all-time highs up there around 339. Watch the red line for the first sign that something might be wrong in the market. Now, what the cues? They are within one more up day, it seems, of setting a new all-time high. This is pretty impressive. Here, the red line is the 20-day EMA as well. We get below there, that would be a sign of trouble. We have not been below the red line since back on, really April 3rd. It's just been an incredible run here. Now, how about Zoom? They're out with earnings after the bell. The high was 212, they closed at 208, and you can see right now we're flirting with 200 bucks. We keep going from 198, 200 here as I do this video around 6:30 p.m. Eastern. What would I watch for just to show maybe that Zoom is no longer going to Zoom and reverse lower? The red line has not been good, but look at that orange line. They bought it here when it hit the 50-day, which is an institutional moving average. They bought it here in consecutive days. It got near it here in May, and then it got near it back on the 27th, just a couple days ago. A close below there would say, you know what? They're no longer buying at the 50-day, they're now selling. Well, at this point, the stock's at 200. That's $48 below. That's a huge stop loss. But given how quickly it's just rocketed higher, zoomed higher, this is really the only thing we can see on this chart to give us an indication that they're no longer buying the dips. So if I was looking for maybe a position in Zoom as a potential trade, bullish trade, I would want to actually let it come back down here, hit 50, get near it, bounce, get back above the 20, and then consider a long. And if that was the strategy, when we break the red and you get back up, there's been nice pops. You break it, nice pops. You break it, nice pops. Maybe something like that, but it would be difficult for me to chase something that's just gone vertical, like Zoom has. DICS, they had earnings. DKS, you can see they did not do well. It was a bad earnings report. They had first thing this morning, but the stock actually closed higher. It breached and closed above the 200-day moving average. It also took out the open on this day here, which the open was 38.17. I'm sorry, excuse me. The open was 38.17. The close was 37.80. We didn't take out the open. We didn't take out the high. We did, though, take out the close on that day, which is what I was trying to say. I typically like to go by closes. And given how big the volume is today, this, to me, even though it's one day, is a breakout. The target now, if I zoom back out, would be somewhere, I'm going to say initially maybe 43, because that's where the ledge before the carnage began, and then back up towards 49. In terms of a trailing stop, the red line has worked well, except here. Then it caught the 50-day and pushed it higher. So maybe the red line would be something to consider as a trailing stop. But today is a breakout on DICS. I want to talk about Tiffany's. There is a rumor, apparently there was this meeting in Europe in Paris, and they were talking about the idea that maybe this isn't a good idea for a leveraged buyout. And the stock today was down almost 9%, over 9% at one point. Here was the buyout. Then we went back up here. It looked like this was going to be the settling price, 134 something. Then during the sell-off, we went all the way down to 105, which is interesting because people were probably fearful that, this may not happen. And then it went back up, but it never could regain that price. This was a sign something would be up, but here's the bigger takeaway from something like Tiffany's. When a buyout comes through or gets announced, unless you strongly believe there's going to be a white knight coming in for a bidding war, it's really not going to go much higher from a probability perspective. But boy, oh boy, could it sure drop. And now you're seeing that happen here with this huge down move. If they think this is going to not occur, then you could think, okay, now we're going to come back down here. And it could potentially go considerably lower. That's why I prefer when it's take a candidate to sell the news. And if that was the case, if we zoom in, the close here on that first day, what was that, 129.72? That was only $5 off the high. I mean, this was just dead money for what, since November all the way to March before the carnage began. There was no money to be made. And now a big chunk of it's being given back. So just heads up on takeover candidates. How about 3M? We could not get above the 200-day back on the 28th of April. We are getting really, really close. If we can pop the 200-day, get above it, then the target would be back up there to those highs in January. How about Microsoft? Had a question on this one, what might look like a rollover? And the question is it rolling over now? No, it is not rolling over now technically. It's just catching its breath. It's up near the all-time highs, but watch the red line. It's so easy. Look how we have not closed below it since what? The 27th of March? No, right here actually. April 1st. It's been really, really good. Even on these dips, these are probing below the 20-day in red. So that 20-day in red, until it's broken, the bulls get the edge and the dips are being bought. So yes, the all-time highs are the target. And how about something like General Electric? This thing just popped, but here's what's potentially interesting. They have massive problems. They went to a new low here in May, which even took out the March lows. How about that for not doing well? But we reversed on big volume. We broke the 50-day, bearish engulfing, but now we're coming right back up. So we broke out, pull back, and now we're bouncing. To me, I would consider, guess what? The 20-day EMA in red, because we could not get above it. Once we got below it back on February 20th, we stayed below the whole time. There we closed on it. Here we bounced twice, and now we're pushing higher. This to me looks interesting. I'm not personally interested in GE, but it is starting to put in higher lows and short-term higher highs. Looks like this is a pop, pull back, and a nice little U bounce. And then one more question on Newmont versus Royal Gold from yesterday. Or from the weekend, I talked about the 50-day moving average in orange as a guideline here to keep an eye on. It broke the red, that's the first sign of trouble, but breaking the orange would be a big deal. Today we had bearish engulfing, but we didn't lose the orange line. Until that orange line falls, the 50-day, I would consider something like Newmont neutral to bullish. It loses the orange, it goes flat out bearish. Now look at RGLD. A little bit of different story. We did close, what was the 20-day? The 20-day is 130.75. We closed at 130.47. Technically, we did close by a few pennies below the red. I would consider that a breach. And let's say I was still bullish on Newmont or Royal Gold. And let's say I had both. This would be an exit, but I could still hold Newmont maybe one more day until it does get below the red line. Now, specifically here on Royal Gold, because it has broken and closed below the red line, the 20-day, this coagulation of the 50-day in orange and the 200-day in purple would be the target, which is about 116, so about 10% lower. All right, that is it. Be back with you probably every other day unless the market starts to have a big move in between. So wish you guys a fantastic rest of the week, and I will see you in the next video. Take a